Listen, sorry to interrupt, but it really is important for us. If you can just hit the like and subscribe button, that allows us to bring you the very best financial intelligence and the best guests on the planet. Anyway, appreciate it. Like and subscribe.
Welcome back to Real Vision. I'm Ash Bennington. Today, I have the pleasure of speaking to Jim Bianco, our old friend. Jim, welcome back.
Yeah, it's good to be back. Thanks for having me, Ash.
It's great to have you with us. Listen, before I get started here, I wanted to mention that Real Vision is organizing an in-person event. The crypto gathering will take place in Miami at the end of January. For details and to secure your ticket, go to realvision.com/CG 2025. That's CG 2025. You can still get discounted tickets. Offer ends November 28th. Jim, it's so great to have you back with us. Listen, back in the old days, we used to do Real Vision Daily Briefing. We only had you for 30 minutes. Then we get to do a true deep dive today. We got you for the full hour. Couldn't be more excited to have you with us.
Yeah, I'm looking forward to it. Where do you want to start?
All right,
Hopefully
Jim,
in the Bronx.
Where do you want to start? I feel like maybe you got something on your mind.
Yeah. I'm happy for the Dodgers. I know that now I've probably alienated half of the audience here. But I'd like to start big picture about the state of the economy and what's happening with the economy. Let's talk about what has been going on for the last 2 or 3 years. And in the last 2 or 3 years, Wall Street has been constantly talking about weakness here, slowdown here, worries about something here or there. And we've termed this the soft landing or the hard landing. But yet what the economy has been doing consistently is, to stick with the metaphor, no landing. It has been showing signs of strength. It has been showing signs of resiliency. And that's been happening again with the latest set of data, especially since the Fed cut rates about 6 weeks ago. And I think that this is the real story right now, is what is the true state of the economy? And I think more and more people are coming around to it's fine and it doesn't need rate cuts. Now, there's a complicating factor that's coming into the economy between now and the end of the year. And that is the 2 hurricanes, Helene and Milton, that came ashore, in late September, early October. The ongoing Boeing strike, which is getting really ugly. It's probably the most undercovered financial story right now, what's happening with that Boeing strike out in Washington State. And the big round of layoffs by Stellantis in Michigan. Stellantis is the old Chrysler. And if you sum it all up, these cross currents are going to impact the economic data. So if I said to you that the economy is looking very good and the Fed doesn't need to cut rates, it might be till January till we get a clear vision of what's going on with the economy right now. Friday's payroll number, Wall Street, it's one of these rare numbers where the Wall Street estimates are between minus 10,000 jobs and 200,000 jobs. That is a massive gap. Now, why is that? The minus 10,000 has got a lot of weather and Boeing suppliers assumed in it, and that could very well be correct. The 200,000 job number has none of that assumed in it, and that could be very well correct. So if you see a weak number on Friday, you could immediately yell weather and strike, and therefore it's not a true reflection of the economy. If you see a strong number, you could say, yeah, but that's no weather and no strike, and that those things might be coming next month or in the revisions, and that could still be an incorrect view of the economy. So it's going to be very difficult for the economic data for the next 2 months or so to really dislodge this argument that the economy is doing very well.
Yeah, and to your final point there, which some people may have missed, which is if it comes in hot or it comes in cold, it still could be revised up or down in the months to come.
That's correct. Remember, just so everybody knows why this is, most economic data is a survey. The payroll report is a survey. They survey 60,000 businesses. And then they ask the business, how many people do you employ this month? And the survey week was the week of October 6th to the 12th. And remember that Helene came ashore like the 29th of September and really ravaged North Carolina. And Milton came ashore October 9th, the last half of the survey week. Now, about half of the companies in the survey, their payroll processor, whether it's ADP or Gusto, whoever it happens to be, just report the data automatically to the BLS as part of the survey. But half of them have to be surveyed. Well, if your business closed and everybody left the state to get out of the way of the hurricane, no one answers the survey. So if you were employing 100 people, use a round number, they then put you down for 0 this month, and they'll call you next month. And next month you may say, no, we still have 100 people. And they'll say, what about last month? We had you down for 0 because you didn't answer the phone. Oh, put me down for 100 last month too, because we were just out because of the hurricane. And that's going to happen with this data all over the place for the next 2 months or so. And the same thing with the Boeing strike. There's something like I've read somewhere between 30 and 50,000 suppliers might be idled. Okay, well, there's 30 or 50,000 people that have been laid off temporarily until the strike gets resolved, and then they'll get hired right back because they're not creating parts and supplies to send to Boeing because that strike is now 5 weeks old, and they've been completely idled with the airplanes that they've been making.
Hey, I hope you're enjoying the episode. If you want to dive deeper and really dig into what's going on and how to understand it, then grab my Everything Code PDF for free. Just hit the link in the description below. You're going to love it. I'm sure it's going to really help you.
And of course, you also have the household survey. This data gets really complicated really quickly. The more you dig in, the more you find underneath the surface. But Jim, let me ask you this. Right now, we're talking about the noise in the data, some of the reporting errors. I remember from my days at Rubini Global Economics that there were a few economists there who would only look at the 3-month moving average of these numbers to try and get some smoothing in. The real question that we're asking here is trying to get a proxy, trying to get an understanding of what's happening with the strength or relative weakness of the U.S. economy. We're talking about the noise. What's your sense on what the signal is? What does your gut tell you based on the broad picture of all the data that you look at? What may be happening in terms of the relative strength or weakness of the U.S. economy right now?
Oh, I think that the economy is showing definite signs of strength. And it is, if anything, it might be accelerating. You see that in the, say the Citibank or the Bloomberg surprise indexes. Those are measures where they look at the consensus on Wall Street versus the actual data. It's been beating since late August. It's been beating quite handily, meaning that the data has been coming in much stronger than expected. And maybe if you want to look at the market, the 10-year yield is up 66 basis points now since the Fed cut on September 18th. This is far and away the largest rise in yields in the first month to 6 weeks after a Fed rate cut that we've ever seen. And what's going on here is I think that the market is somewhat rejecting the Fed's rate cut cycle, saying that it's not necessary and that it is going to maybe be too stimulative. And if I could pivot a little bit to the election, there is a widespread expectation now that Trump is going to win. And it's close. The polling and our expectations could be off, but we are expecting a Trump victory. What does a Trump victory mean? It means tax cuts, deregulation, and tariffs. That's fiscal stimulus and tax cuts. That's unleashing businesses in deregulation, and tariffs are adding price to imported goods. That's inflationary. And what the market is saying is, there's your stimulus. There's plenty of stimulus. Jay Powell, we don't need you cutting rates. You're just piling on, and you're going to create an inflation problem probably sometime in 25 with all your rate cuts. And that's why I think that the first reaction was, remember all those stories about the Fed cut rates? What does that mean for borrowing costs? What does that mean for consumers? No one wrote the story, you better refinance today because it's going to get worse tomorrow, because that's exactly what's happened. And the reason that every market-based rate has gone straight up since the Fed cut rates is because the fear is we don't need those rate cuts. You're going to overstimulate the economy, at a time it's going to get a lot of stimulus from a potential Trump victory, at a time that it's already strong, and we're just setting the stage for more inflation. And that's why you're seeing the 10-year yield go straight up in yield, because it's discounting the potential of higher inflation somewhere in 2025.
You have so much to talk about here. We've got 3 hours worth of conversation and just that to unpack there. There's so much.
We're going to go Rogan here on me. We'll go 3 hours.
We'd love to do that. That would be a great show. But listen, let's talk about this. And because this is so important, talking about yields, we'll talk about the election in just a second. So obviously 50 basis point cut, September 18, 2024. You mentioned it there. You can see it on the 2-year chart. You can see it on the 10-year chart as well. You get this dip, and then you get this reversal of the dip. Talk about what's happening. Is this sense that maybe the Fed is losing control of the narrative, that perhaps this inflation pressure, that the fear is in the bond market to see? I mean, I was looking earlier today. I mean, we're still PCE. We're at like 2.3%, 2.2%. There isn't this yet in the data. You haven't seen this inflation, but is it about expectation going forward?
I think it's about expectation going forward. And I would argue that it is somewhat in the data. PCE, you're right, is about 2.2, 2.3. CPI is about 2.4. It's close enough to 2% for government work, isn't it? Yeah, but what that has come about from is a $30 decline in in crude oil prices, which has brought down gasoline prices by about 40 cents since the spring. Now, if you look at the core numbers, let's use core CPI. It still is not under 3%. And that is a wholly unacceptably too high inflation report, being at 3.2%. Although right now we're using our anchoring bias and saying, well, it's the lowest it's been in 2 years. Yeah, but anything other than the previous 2 or 3 years, and that number would have had everybody breathing in a brown paper bag, hyperventilating about an inflation problem. Now we're saying that core inflation at 3.2% is solved inflation. It's nothing of the sort. So what we're seeing in the headline number is a depression from gasoline prices because of the big drop in crude oil prices. But we're not seeing that being pushed through and anywhere else. And that's where we're at with the data now. You add in all the stimulus that I was talking about, potentially fiscal stimulus with a Trump victory, with the Fed cutting rates. I think that could then, push the inflation story. And let's also remember how the Fed started. They started with 50 basis points, not 25. Right after that meeting, Austin Goolsbee, the president of the Chicago Fed, came out and said that the Fed funds rate at 4.75% to 5%, which is where it is right now, is still restrictive. In other words, in Fed parlance, they have what they think is a neutral rate. The neutral rate is, where do we send rates where they neither stimulate nor restrain the economy? And Goolsbee said it's hundreds of basis points below where we are right now, suggesting low 3s to high 2s is where the neutral rate is. So he said that they went 50, they got hundreds of basis points to go to get to neutral. And I think the market said, whoa, you guys are going way too aggressive here. And you signaled an aggressiveness of 50. 50 basis points in September in and of itself wasn't a problem. It was the signaling with what Goolsbee said, you're going to chop rates hundreds of basis points. We don't need that kind of stimulus. And that's why I think that the market is worried about inflation. And, we'll have to see, what the Fed winds up doing next week. Now, the expectations are, and the market is pricing 25, and that there would be another 25 in December. And again, this could be another bad reaction. You're not getting it, Jay. You're still giving us too much in this strong economy. And because you're giving us too much in this strong economy, we're just going to have to push interest rates even higher.
Yeah, meaning push interest rates even higher in the bond market.
In market-based rates, the funds rate at the front end of the curve is their signaling device, but market-based rates, will react to what the Fed does, plus a whole other host of indicators and expectations. And if they see the Fed as being too stimulative, that lowering the funds rate makes bank loans cheaper, that makes banks be able to hand out more loans at cheaper rates, which means companies will ramp up even more economic activity, that the bond market might view that as, oh, we're just going to create more inflation. So therefore, market-based, longer-term market-based rates like the 10-year note would wind up going up in yield.
Yeah, and harder for the Fed to control the back end of the curve, or even the
Right.
belly of the curve there in the middle. Federal funds rate right now, 4.75 to 5%. Let's talk a little bit about the impact of inflation and how you see it. I think it's very difficult for people, especially people who don't live in the bond market, people who don't have PhDs in mathematics, to sort of understand the implications of this. They feel it when they go to the grocery store. They know it in their gut, but it's hard to understand the sort of the way that the math maps onto the reality. I tend to think of inflation, and well, the way that I generally try to explain it is it's a rate. Other things that are rates in your life would be speed, right? It's the amount of distance that you're covering in a particular time. And one of the things that makes inflation so pernicious is that when you have these sustained rates of elevated inflation, even if they're not the sort of terrifying numbers that we saw in the reopening, you have this sustained rate over time, and it leads to significant pain and significant erosion in purchasing power. This is why every cashier I know at when I go to a grocery store says, how many people say wow when they look at that number? It's a lot. It's absolutely brutal. It's been sustained over time. Talk about some of the macroeconomic impacts of that as you see them, Jim.
Axios had a great chart over the summer, and it was a chart of the rate of inflation, as you were talking about. It went to 9% in 2022, and then it fell back down to like 3% in recently, and now 2.3%. And they said this is what economists look at when they talk about inflation. The next chart they had to the right of it was the cumulative increase of inflation. And the average price over the last 4 years is up something like 20 to 22%. So whatever cost you $100 at the grocery store 4 years ago costs you $122 today. And they said, this is what normies think about inflation. And so
Right.
in this also goes to what you see in the political polling, right? In the political polling, what is the number one issue, bar none? The economy. And what is the biggest part of what they're worried about with the economy? Inflation. And when the economists say, yes, but it was 9%, it went down to 3%, the normies are saying, no, it's $122 to buy the same things that it cost me $100 4 years ago. And that's why they're reacting to it. Also, keep in mind that those numbers that we're talking about, it was 9, went down to 3. Those are positive numbers. That means that the inflation rate goes up every year. That means that $122 that you're spending at the store now relative to 2020, you're going to spend even more next year because we don't have a negative inflation rate. Biden tweeted out, or should we say whatever intern runs his Twitter account, that the inflation rate was 9 and it is now 3. And if companies don't start cutting prices because it fell from 9 to 3, that they're going to start looking into it. And it's like, oh, so tell me that you don't understand inflation without telling me you don't understand inflation. 3% means they're still going up in price. They're just not going up faster. And therein lies the problem. You had a big step increase of inflation in 21 and 22, maybe, into late 22 because of that big 9% bulge. And then it never backed off. It then went back to continuing to rise at a normal rate. So you still have to pay those higher prices forever. And that's why, the last thing I'll say about inflation is that's why inflation is probably the most important economic thing to think about. It impacts 100% of the population. It impacts every single person. It impacts Elon Musk. It impacts the prices that he has to pay at SpaceX and at Tesla. It impacts the prices of everything. It impacts what we pay at the grocery store. It impacts what our companies have to pay, what our suppliers have to pay. It is a very virulent thing that when you get inflation, it can be devastating to an economy. Way worse than unemployment. As a matter of fact, the last thought I'll give you on this is there was a survey done by one of the political pollsters, and they asked people If you could fix the inflation problem with a 1% rise of the unemployment rate, should that happen? And the overwhelming majority of Americans said, yes, do it. In other words, if we have to throw 1.6 million people out of work so that the other 300 million people could see prices come down or at least stop going up, sorry, 1.6 million, you're just going to have to get sacrificed. That's how pernicious inflation can be, that people would think that way, that they'd rather throw 1.6 million of their fellow citizens out of work to get rid of this inflation problem.
Yeah, I mean, it reminds me of the old Ronald Reagan joke about the difference between a recession and depression. Recession is when your neighbor loses his job, and a depression is when you lose yours. But the idea here is a serious one, which is that when you have inflation, it is 100% of the workers in an economy, 100% of families are paying those prices. And in addition, as you point out, of course, obviously the input costs into everything that gets produced, whether a good or a service.
Right. The other nuance I would give you about inflation, because we tend, we did it here too in this conversation about the grocery store and everything. If you look at the CPI basket, and I think it's fairly accurate, 75% of what we spend our money on is services. It's not goods. It's about 25% of it is goods. What is the biggest driver of services is wages. So when you watch and you see that the port strike was settled and that there's a 63% increase in wages, that the Boeing workers were offered a 40% raise in wages, and that they turned that down because they want more wages. And you see that wages are going up quite a bit. That means that services are going to get more expensive, because that's the input. A service is basically labor, and labor is wages. And so if services are going to get more expensive, then that means that the inflation rate is not going to come down. And that's ultimately why the inflation rate and wages can never really decouple. Because, some people have argued, well, maybe we could get to a period where wages can grow at 4 or 5%, but the inflation rate can grow at 2%. But they can't. Those two things are tied to the hip. If wages are growing at 4 or 5%, which is what they have been growing at, then that means that all services are going to become 4 or 5% more expensive in a year. And that now they don't have to go up, penny for penny with wages, but they're going to be very, very related to each other. So higher wages are going to keep dragging up the price of services. And that's ultimately what we pay most of our dollars with, is the purchases of services.
Yeah. Jim, I want to shift gears here to talk about something else that you just mentioned, which of course is the election. Obviously, we're about 7 days out right now. I avoid talking about politics like a plague on this show, but this is something that I think is just too important to ignore right now. And to me, the single biggest story, the single most confounding story is this disconnect between what seems to be happening in the betting markets versus what seems to be happening in the polling data. I follow the polling data relatively closely, and it seems like the smartest people in that space are saying it's toss-up. We have absolutely no idea where this is going to land on November 5th or 6th or 7th. I mean, it's just that close that we may not have an outcome the night of the elections. But when you go up to Kalshi, you look at the betting markets, very, very clear lead that Donald Trump has. I'm looking right now on Kalshi, 63 to 37%. Plus, you could say risk asset markets pricing in a Trump win. What's happening with the disconnect between the money and the polling in this election?
So first of all, I'm looking right now, Polymarket. Trump is trading 66.6. So Trump is trading 666. Coincidence or not? I'll let you decide that one. That's the only political statement I'll make here. But let me push back on the premise. I've been very vocal on social media, especially on Twitter and on LinkedIn, to argue that there is no manipulation in the betting markets, and that if you were to put together a fair value model for the betting markets, that trading in the low to mid 60s is exactly where they should be trading, and that is where they're trading. Now, how do I arrive at that? And what I'm trying to argue here for people is, yes, pay attention to the betting markets. Yes, let me tell you what they are. They are the summation of what we know into one probability. That's a probability. A key thing about probability is when you see people say, Trump is trading with a 33-point lead over Harris, 66-33. That's basically, let me tell you, I don't understand probabilities without saying I don't understand probabilities. That's not the proper way to look at a probability. 66% means he's got a 1 in 2 chance of winning the election, or 2 out of 3 chance to be more specific, to win the election. To put this in football parlance, and then I'll talk about why I think it's appropriately valued, because it is football season. If Trump is trading 66 on down, and he's trading 66 on Poly, and he's trading 63 or so on Kalshi, he's got less than a 3-point lead. A Harris field goal wins the game. That's how close this is. It's late in the fourth quarter. She's down by less than 3 points. If he trades between 66 and 80, he's got between a 4 and 7 point lead. A Harris touchdown wins the game. It's a little harder, but not impossible. If he trades above 80, he's then trading more than 7 points above. Then it's 2 scores by Harris, and that becomes a lot more difficult. So yeah, no, that I think the problem is people look at these markets and they say 66 is very much different than 55. It really isn't. It isn't. Now, why do I think that mid 60s is appropriate? It's a futures market. It's a futures market that will expire. I agree with you. Sometime next week. It should expire a week from today, but it should expire sometime next week. How do you price a futures market? You need 3 inputs. You need the spot rate, you need carrying costs, and you need expectations. So let's start off. What is the spot rate? Okay, I've argued, and I even tweeted about this the other day, look at Nate Silver's Silver Bulletin, or look at the 538 model, or look at the Economist model. These are modelers that use all of the known information, and they put out a model of what they think the probabilities of the election are. Trump is trading at 54 to 55 in all these models. So that's the spot rate. Start with that. The modelers have him at 54 to 55, carrying costs. I'm tying my money up with this. I'm not getting interest on it, but it's only a week, so there's really no carrying costs are negligible. Expectations. All right, the spot rate's 54, 55. But Trump has been in an uptrend, and the perception is Trump is going to win. He should trade at a premium above the spot rate. In the futures markets, we call that contango. He should be trading with contango, which is what he is. And he's trading in the low 60s, 63 to 66, say 55-ish or so, 54 is where the spot rate is. It's all reasonable. That's exactly where it should be. That this whole talk about manipulation, look, I first started trading in the betting markets in 1992. I lost a ton of money in the betting markets in 2000. By the way, the reason I say it that way is because I made a big bet that George W. Bush was going to win the recount. So I went in and I bet big that he was going to win the recount. He did, except I bet the wrong contract. I bet the contract that he was going to win the popular vote. He went to the White House and I wound up with 0. So my warning to everybody is read the contract, read the specifications of the instrument you're buying to make sure you understand what you're buying. I made that mistake in 2000. I will never make that mistake again. I always carefully read every contract that I'm buying. So no, these markets are appropriate. And every time you hear talk of manipulation, it's always the side is perceived to be losing. So yes, Trump is a favorite, but it's not impossible for Harris to win this game. She's a field goal away from winning this game, but he's ahead late in the fourth quarter. And yes, the scoreboard of him being at 63 to 66, because that's what I think manipulation is. It's the coach, stick with my football metaphor, pacing the sideline going, that scoreboard is wrong. I'm winning this game. No, you're behind, but it's doable for you to win if you'd stop complaining about the scoreboard and start constructing a strategy to win the game with the little bit of amount of time that's left. So he is ahead, and that the betting markets, I think, are appropriately priced.
Well, Jim, I think you managed to square the circle there, because I think this disconnect was something that a lot of people have been thinking about. By the way, not a political statement, but if the Giants were up 2 points in the fourth quarter, I would assume they would find a way to blow the lead.
Well, like my Chicago Bears did with the last play of the game against the Washington Commanders on Sunday. If you saw the 60-yard Hail Mary that they lost on, yeah, it happens all the time. It doesn't mean it's going to happen this time, but that's the way you have to think about it if you're a Harris supporter. As we understand the data, and I'll make one comment about that. As we understand the data, he's ahead, but not that much, and it can be turned around. Now, there's another argument you can make too, that what we understand is wrong. That happened in 2016. As we understood the data, Clinton was ahead and Clinton was going to win, and that was wrong. And now, is this wrong? Sure, it could always be wrong. In fact, I would even argue to you it is wrong. We just don't know how it's wrong at this regard. Remember, in 2016, we underpolled Trump. He outperformed the polls. In 2020, we polled Trump again. He actually outperformed the polls by more in 2020 than he did in 2016. The difference was
when, by the way, in 2020, they told us that the pollsters told us they had figured out a way to correct for it, and the spreads widened, to your point.
Right. The pollsters told us that they corrected it and it got worse. The difference in 2020 was Biden had such a big lead that when you have this lead, he still wound up winning the presidency. Clinton's lead wasn't big enough in 2016 that when you added in the polling error, it flipped the election. Now, 2024, did they fix the polling error? Everything I've seen, even Nate Silver says, we don't know. We just don't know if they fixed the polling error. Now, maybe they have, and maybe these polls are right, or maybe we're undercounting Trump again, like we did the previous two, or maybe we're underestimating Harris support or turnout or something like that. Sure, that's always possible. In which case, you then have to say, look, by available information, Trump is leading, but I think that there could be a mistake in the polling or in the perceptions, and therefore Harris winds up winning. Sure, that's very possible. But you have to make that case. Most people make that case emotionally. I want Harris to win, so therefore I will believe Harris will win instead of giving hard evidence. I think Silver's got it right. We just don't know if there's a polling error this time around. We will make the assumption that pollsters want to continue to be employed as pollsters, and what their primary objective is to be accurate so that they can continue to get gainful employment after next Tuesday, and that they're trying really hard to be accurate, and we'll find out in a week if they are accurate.
Yeah, I actually subscribe to Nate Silver's Substack as well. And here, I want to read this. This is the opening line of Nate Silver's Substack, and it's been the same for the last 10 days or so. Let's cut to the chase. So who's going to win the election? Well, honestly, we don't know.
Exactly.
We don't know.
And that's why I would come back to what I said before. People that are arguing 63, 64 is wrong from 55, because his model is at 54, 55% Trump, is wrong. That's in a probability world. The difference between 54, 55 and 63, 64 is not material. And people think that incorrectly, because they'll say Trump's 20 points ahead, as if that's a vote share, as if that's a runaway election. Remember, in a week, one of these is going to be 1 and the other one's going to be 0. That doesn't mean that Trump won every single vote in the country, because he winds up paying off, $100. It's understanding that these are probabilities, and we overstate the importance of these probabilities by arguing that he should be 5 points lower in the markets. That's not material. But like I said, if you start off with the spot rate of, say, Silver's model at 54, 55, if you look at the chart of all the models and all the polls, and that Trump has been going up, you'd say, okay, the expectation is that trend will continue. He should trade at a premium. And that's how you wind up in the low 60s. And understanding that in a week, it's going to be 1 or 0. So it shouldn't be like a 1 point premium. It should be bigger. And the last thing I'll warn everybody is,
hopefully in a week.
Yeah, hopefully in a week.
It'll be 1 or 0.
There's an argument, just as a quick aside, I love this delicious Mark Halperin, who's a political analyst who runs the Two Way podcast. pointed this out, that there's some pollsters that are saying because of the sheer amount of people that vote early, and now that the pollsters have been analyzing early votes, there's actually an argument that could be made that they could actually call the election the day before the election. Not who they think is going to win, that it's already over because of early voting, and that the election day is largely ceremonial. Now, no one's going to do that, but I loved it because it's so deliciously contrarian that we can actually call it the day before the election, that not you're going to win, that you've already won the day before. I'm not saying that it would be Trump, and I'm not saying it would even be the presidency. And he was more focused on Arizona. Something like 95% of the balloting in Arizona is going to be done early, and that they could actually start calling like the congressional and the Senate race. They could call it at the end of the week before election day, because they could just look at the early voting numbers as well. So yeah, I mean, this is going to. You're right. We don't know who's going to win. And we need to understand that these are probabilities. These are not vote share totals. And when people say Trump's got a 25-point lead, they're implying that these are vote share totals, and they're not vote share totals.
Jim, I just had a mini epiphany while you were speaking, and you tell me if you agree with this or not. But one of the problems that we have is a single word, and that word is prediction. We call these prediction markets, right? That's the term of art that most analysts use. They're not prediction markets. They're betting markets. You're not predicting, you're betting. You're seeing where you, based on the rate of return, the net present value of the bet, where you're going to get paid. And it's not a prediction, it's a bet.
Right. We'd be better off calling these probability markets, because, that is a better option. Look, as Silver would point out, as I would point out to you, if Trump is trading 66, just to use that number right now, that means if you had 100 elections, Harris wins 33 of them. That's a significant number. That is not to suggest by any stretch of the, and this could be of the 100 iterations of this one could be one of the 33 that she wins. And that's the way you have to start thinking about these markets, instead of, stammering around that they're somehow manipulated, or that there's a big whale that's put prices. There's whales in every market. Or discounting the idea that, it's a bunch of crypto bros that are in their 20s wearing MAGA hats that are voting on it. Make one assumption. Even if that is true, they want to make money. They're trying to make money. If you want to make that argument, then let's just say that Wall Street is full of old white guys. So how could they give an opinion about cosmetic companies? What do they know about cosmetic companies? All these old white portfolio managers. We don't think that, because we assume that the portfolio managers are there to make money. So their demographic doesn't matter. Same thing with the bettors. We assume they're there to make money, and so their demographics shouldn't matter.
Let's shift gears here and talk a little bit about U.S. equity markets, as we're talking about pricing in net present value of future cash flows. Let's talk a little bit. Obviously, 6-week winning streak snapped last week. Year-to-date basis, this is interesting. S&P 500 up about 23% year-to-date. On a trailing 12-month basis, up nearly 40%. Obviously, these are some base effects, and it's strange because we're very close to the end of the year, but sometimes that's the way the trailing data set looks. Jim, what do you think about U.S. equity markets? What's your view right now?
So, by the way, you want a fun fact about the U.S. equity market? The number of, you mentioned that the U.S. equity market's up 23%. The gold market's up a little in the low 30s, around 31, 32%. The number of times that the U.S. equity market and the gold market have both been up 25% in the same year. Remember, we're up 23% in the stock market, so we're close. 0. So we're in the range of potentially doing that for the first time, that both gold and stocks could be the big winner in the same year. So there's your fun fact for the day. But now,
so other than being a fun fact, what does that mean? I mean, that is really interesting.
Yeah, it is interesting. And I think if I was to give you an explanation of that, is what I believe has been the primary driver of gold this year has been and most of it has come in the second half of the year. Most of the gold rally, if not all of the gold rally, has come in the second half of the year. I think it's been monetary largesse. I think that the gold market is looking at too easy policy with the rate cuts, the expectation of rate cuts, the reality of the rate cuts, that policy has been too easy and that policy is going to produce inflation. Remember what gold is. Gold is a hedge against uncertainty and bad things, whether it's war, it's pandemics, or it's inflation. It's not only inflation. It's what you buy when you think bad stuff's going to happen. And inflation falls into that category. But that monetary excess also could lead to strong nominal growth in the economy. Nominal growth means real growth plus inflation, the two together. If I'm running a business and I've got strong nominal growth, I can both raise my prices and people are walking in the door to buy things because the economy is moving forward, unlike Europe, which is a whole nother issue, which their economies are in the opposite. They're a mess, they're in recession or very close to recession. Ours is very, very strong. But if you have strong nominal growth, that's good for corporate earnings. That's good for the discounted cash flows. And that continues to push the equity market higher. Now, let me tangent this and throw in another argument here. Dr. Jeremy Siegel wrote the book Stocks for the Long Run. In the book, he talked about what should you expect for stocks going forward. Now, what they've done, 23% this year, 20% last year, big negative in 22. But what should you reasonably expect for the stock market going forward? If you take the inverse of the PE ratio is in the low 20s, and you take the inverse of the PE and you add 2 or 3% real, you can look it up in the book, and I'll give you the bottom line. A reasonable expectation for the stock market for the next several years is it returns you somewhere between, say, 6 and 8% a year. So it goes up 6 to 8% a year, somewhere in that range. It could go up 16% one year, 0 the next year, but that's what you should expect. Sure, you could get more, but that's what you should expect. Okay, this was 2019, and we were saying, look, the stock market's going to give you 6 to 8%. But the bond market's somewhere between 0 and 2. We used to scream the word TINA. There is no alternative. You got to get all your money out of bonds, and you got to get into stocks because stocks have return. Bonds don't because of their low yield. Today, you don't hear anybody talking about TINA because now take the Bloomberg Aggregate Index. Its yield is about 4.8%. It is offering you about 2/3 of the yield is offering about 2/3 of the return of the stock market with probably 1/4 to 1/5 of its risk. And at this point, a bad year in the bond market will probably be a 0 return. A bad year in the stock market would be a down 20% return. So what I'm arguing is the stock market has competition, and the competition is the bond market. Now, I know some people that are more crypto-oriented will, no, the stock market's supposed to go up, 20% a month or 20% a quarter. Bitcoin's supposed to go up 8% a month. These are high-risk investments, but the broader market should be about a 6 to 8% return. And in a world of 5% or 4, high 4s interest rates, that is real competition. 2 other things about that. One, the flows in the bond funds this year is the highest it's ever been. And there's still 2 more months left in the year. And we've already set the yearly record. And in second, this becomes the issue with the bond market. I've argued that as rates go up, that the bond funds become more attractive relative to stock funds. I could get most of the gains that the stock market would offer me with a lot less risk because of the big yield in the bond market. Sign me up. Who does that? The people that have money. Who are the people that have money? Boomers. It's always going to be the way the world works. The older people have most of the money. In 20 years, the Gen Zers are going to turn up their nose and make fun of all those 60-year-old millennials that they have all the money. And in 50 years, Gen Alpha is going to make fun of Gen Z being a bunch of 60-year-olds that have all the money. That's just the way the world works. So the boomers have all the money. What is a bear market? Bear market is time, not price. What do I mean by that? Sure, the stock market might sell off and it might go down and it might chop around sideways for a couple of years. If you're 35 years old, great. I wish we would have a sell-off so I could buy in cheaper and not going to add dollar cost average at much lower prices. And then after several years, it's its footing and it has another 20-year run. But if you're 65 years old, and I said that the stock market might be peaking and it might go into a sideways chop for 5 or 8 years, you might be correct to say, isn't that half my life expectancy? I don't have time, that kind of time, to wait around for the stock market to get its footing again. No, those bonds are offering me most of what the stock market could get with a lot less risk. I'll take those. And so that's why I think that the bond market is now offering real competition to the stock market. So as yields go above, the 10-year yield goes above 4.25, that's the point we've argued with it right now, the stock market starts to hit a headwind. And that's been happening with it for the last couple of weeks. It, peaked on the 14th of October, and it's been kind of chopping sideways. And I think really what it is that it's yields. We're fine. The move from 360 on the 10-year note, which is where it was in late September, to about 420 didn't bother the stock market. But as you get above 4.25 and you start creeping up above that number, the stock market starts to get bothered by higher and higher yields because of the competition that the bond market offers.
Jim, extremely well explained. We've gone from Tina to Tia. There is an alternative, 4.333 on my screen right now on the 10-year Treasury yield. By the way, this is a perfect lead into a question that we just got from Paul E., one of our viewers, who wants to know, for those who are retired and looking for yield income, what duration do you think we should focus on to lock in income? A great question and very much on point here.
So I'm going to be very careful in answering this question because there's a bit of a conflict of interest in this question answer. And I'll give you the conflict of interest. I do manage an ETF, or to be more specific, I manage an index called the Bianco Total Return Index. BiancoAdvisors.com, you can find out about the index. It is a discretionarily managed index. We basically set up a portfolio in the form of an index that we think will give you the best fixed income return. There is an ETF run by Wisdom Tree, WTBN, Wisdom Tree Bianco Nancy, WTBN, which is the Wisdom Tree Bianco fund that tracks our index. So we are effectively running an actively managed index. Now that I've said that, I think active managed is probably the best way to go when it comes to fixed income, whether it's our fund or any of the other ones, and there's a lot of good ones out there. Why active management? Well, your first response might be, well, no one can beat an index, right? In equities, that is the case. Over the last 3 years, according to the S&P index versus active, which is called the SPIVA report, which looks at active manager returns, 85% of active equity managers cannot beat their benchmark, like the S&P 500. So just buy an index, buy VOO or SPY or something. If you were to give your money to a professional manager, 85% of them can't beat that anyway. So that's why indexation is so popular in equities. But in fixed income, over 50% or around 50% of active managers can beat the index. So if your argument was, should I buy BND or AGG? These are indexes. BND and AGG are the two biggest bond ETFs in the world. They track the Bloomberg Aggregate Index. I believe AGG is Vanguard and BND is iShares, BlackRock, although I might have those reversed. But they track the Bloomberg Aggregate Index. But an actively managed index historically has a 50% chance of outperforming. Why? The bond market's a very different animal. And I'll give you one simple explanation for why active managers in bonds can outperform, but active managers in stocks can't. In stocks, your biggest weightings, your Magnificent Seven stocks, are your all-stars, your stocks that have gone up huge. If you're not all in all the time, pressing the bet on all those Magnificent Seven stocks, that is half the game. The S&P is up 23% this year. Something like 12% of that is 7 stocks. If you were not pressing the bet in those 7 stocks, you had zero chance of outperforming the S&P. And that's very difficult for an active manager to do because those stocks, by most explanations, our understandings, are overvalued, have overbought, and present a lot of risk. But in fixed income land, your biggest weightings, your over-leveraged companies, are your countries that borrow too much money in structured products like mortgages, your bad structures. In other words, they're your problem children. Whether you're all-stars in equities, they're your problem children in bonds, and you can recognize them as problem children and avoid them. And that's a big reason why a lot of managers outperform in active management. So I would argue that the best way to look at it in fixed income land is look for active managers. In fact, it's one of the fastest growing categories in fixed income right now is actively managed ETFs. And that is probably the best way to do it because the bond market is structured in such a way. So the question is asking, should I put a bond ladder in? Should I buy this index or should I buy that index? And then when should I change the index around? That's what active managers do. And that's why I think that they're very successful in fixed income, where they're not so successful in equities, because one is the all-stars and the other one is the problem children.
Jim, that's so interesting to talk about. Obviously, we've had this conversation on Real Vision a lot about passive indexation, but you're talking about 50% return from 7 stocks. I mean, it is, you could look at that on the face and say that seems like it's problematic, maybe problematic at the macro level, problematic at the level of potential. Go ahead.
I would say this, 50% of the return from 7 stocks, and that their weighting is something like 27% of the S&P, those 7 stocks. That's unprecedented. That there is no, when was the last time 50%? Well, 50% came from 7 stocks when the stock market was up 1%, or when the stock market was up 0.5%. But when it was up 20 odd percent and 10 full percentage points of the S&P's return came from 7 stocks, unprecedented. Not in 2000, not during the Nifty 50s in the 1970s. There's no, not even in the late 1920s. Before the stock market crashed to 29, did we see this big a concentration of stocks have such a big weighting and drive such a big portion of the returns? Now, you may say that sounds ominous. I wouldn't disagree with you, but I would warn, we have no example of a historical example of how this resolves itself. I could give you a pessimistic way it resolves itself. I could give you an optimistic way it resolves itself. But what I can't give you is a historical example of how it's resolved itself.
Yeah, such a good point. Jim, one other thing I want to ask you, I know you've got a hard stop here at 11:30. Bitcoin creeping up to 72,000 on my screen right now, 71,937 looks like. What's your outlook on Bitcoin? What's the expectation here? Is this pricing in a Trump victory and the expectation of regulatory clarity?
I do have a few minutes past 11:30 right now, maybe about 10. So if you wanted to go a little bit longer. But to answer your question, I think you're right with the way you structured the question. Remember that in July, Trump went and spoke at Bitcoin Nashville. And he cemented the idea at that conference that the orange coin and the orange man are kind of joined. It is a partisan coin. So you like that one, huh, Asha? So part of what's going on with Bitcoin is it's rallying the same way that DJT is rallying. I've got it up on my screen. The Trump media stock is going absolutely vertical, and the 66%, that we talked about in the betting markets and everything else. That Bitcoin is part of that. Now, is this buy the rumor that Trump's going to win and sell the news on the election? Or is this something more than just the election that is been unfolding in Bitcoin? 2 things I'd also want to throw out about Bitcoin. I've been somewhat critical of the ETFs, not that they're a bad product, but that I've argued that they're a cannibalization product. The price of Bitcoin peaked to 74,000 back in March. Why are we sitting here in late October when there's been all this money that's gone into these ETFs? Something like, $23 billion or so year to date, smashed every record for a new ETF launch that we've ever seen. And we're still 6 months out and we still haven't made a new all-time high. Because where did that $23 billion come from? Now, everybody wants to say boomers. It's come from boomers that have never owned Bitcoin and that they're now buying the ETF because they can. No, I think the vast majority of it is coming from Coinbase accounts, Kraken accounts, Gemini accounts, cold storage wallets. It's already money that was in the coin to begin with. It's just transformed itself into a TradFi account. And ultimately, that I've argued is worrisome, because what that is saying to you is, that whole online community with, cold storage accounts and everything else, it sucks. I would rather have my money in a regulated account. The whole idea of self-sovereignty and holding your own keys, which is the bedrock principle of Bitcoin, not interested in it. I'd rather have Larry Fink hold my Bitcoin for me and run dominion over me in terms of regulations with him and the New York Stock Exchange and the SEC. That's worrisome. And that's one of the reasons why I think that Bitcoin, despite all this money, it's money that was already in the ecosphere, just transferring itself into a traditional brokerage account to buy the ETF. And this message there for the crypto community is why? Why is everybody rejecting what you guys are doing? And they just want to own it in their TradFi account. Now, there's some money that's coming in, from endowments and trusts and from individuals, and that it's first time money, but it's not nearly as much as everybody thinks it is, as well. So what I've argued is, what's holding back Bitcoin from going to 100,000 or 3 million, like, I've heard some estimates now and stuff like that, is I think it's been development and adoption. You need more the basic question is, what does Bitcoin do? It could do a lot more. We've got ordinals, we've got Sats, we've got, the Lightning Network, which is a little bit old. There's a lot of things it can do on top of those and even more. Let's get there. Let's get more development into the crypto sphere. Let's become maybe a means of payment. Let's become something more than a store of value with it, as opposed to, no. I'm just going to own it. I'm just going to own IBIT in my brokerage account, and I'm just going to wait for that magic number to go up and make me rich. It's only going to make you rich when we have some more breakthroughs and more development with Bitcoin. And I think if we're chasing all the money back into TradFi accounts and out of the self-sovereignty and out of the blockchain itself, that ultimately is going to retard the development of the coins and make it harder for the price to go up. This whole argument that somehow the ETF was going to be a gateway drug, that people were going to buy IBIT, and then pretty soon they were going to start exploring Coinbase, and the next thing you know, they're going to own all their coins in cold storage. It's gone 180 degrees the other way. And that is worry, So as positive as you thought that was going to be the gateway drug to get everybody into blockchain, you should be worried that the reality is it's going the other way. And that is the biggest warning sign that I see from Bitcoin. So yes, it is rallying because it's the orange coin with the orange man. I fear that it might be a sell the news on the election, especially if he was to lose. But beyond that, we've had the halving, we've had the big inflows. We can't make a new high in price. We need development. We need more development. We need more use cases for it that will drive more online adoption, crypto adoption, as opposed to TradFi adoption. And then we could start to really see the price cook. And I'm still optimistic we're going to get it. It's just that it might be slower than we think because of this migration of money the wrong way back to TradFi accounts.
Yeah, Jim, I agree actually with a lot of the points that you just made there. Boy, this is a whole show in itself. How do you want to own Bitcoin, even if you are bullish on it? And I think obviously there are a lot of options. And I think quite clearly, you would have been far better off trusting your money with Larry Fink than you would have with Sam Bankman-Fried. The worst way to own Bitcoin is an offshore exchange that's unregulated and that goes belly up. People lost huge amounts of money, obviously, with the distributions. They're getting it back in with interest, but still a pretty terrible ride for those who did it. If you were on a regulated or at least publicly traded, I guess I should say, might be the proper term of art, onshore exchange like Coinbase, you did just fine. But by the way, people who are very passionate about Bitcoin, as you point out, would say not your keys, not your coins. People have lost money with self custody, right? It is not an easy thing to do if you don't do it exactly correctly. And I think you're spot on by saying what the space really needs is more development, which I think is going to come. It's a process. The internet didn't arrive fully baked in one day. It's a process, but the UI, UX, the user interface, user experience for digital assets, I think is going to improve over the years, but it does take time. And I think it can be frustrating for those of us waiting to get here. So it becomes as simple as, paying for something with Apple Pay. It's not there yet.
Yeah, you tell a normie, to speak to the crypto crowd, you tell a normie that there's no 800 number to call when you lose your seed phrase to get your money back, and that scares the living hell out of them. And multi-sig might be an answer to that, or there might be other kind of recovery solutions for that. But that's a big reason why I think a lot of normies are deathly afraid of basically owning their own keys. In the case of some regulated entities like a bank trust department or a pension plan or a trust or an endowment, they're even afraid to own it in that format because I might employ Ash Bennington, and Ash might know the seed phrase as part of his job working for my endowment. And then one day Ash leaves. I can't change the seed phrase. And I can't change the seed phrase every time somebody leaves. There's a vulnerability there, and how do I overcome that vulnerability? And so this is what you got to do in order to get people on chain. Otherwise, if they stay in their TradFi account, we're not really fulfilling the mission of Bitcoin.
I think you're right. I think it's multi-sig, and I think it's wallet abstraction. The idea that you can program in an arbitrary amount of logic into wallet abstraction is probably the solution. But again, to your point, Jim, it doesn't arrive overnight. That's not going to be here next Tuesday.
Those are you're right. Those are the solutions. But you know what? It's October 29th, and they're not here now. And that's the are they going to be here tomorrow? Then we could start making the case to the IBIT crowd, get into come this way instead of going the other way. But they're not here yet.
I will never miss an opportunity to run long on a Jim Bianco show, but I know you do have to go in a couple of minutes. So I want to give you this opportunity. Final thoughts, key takeaways. We've covered a lot of ground here. We did the big picture from where we are today on September 29th. What do you think's happening? Big picture, what do people need to watch going forward until you can rejoin us again on Real Vision?
Well, other than the election, I do think that they should basically watch interest rates and keep in mind the simple fact that rising interest rates are neither good or bad. Falling interest rates are neither good or bad. You have to ask the question why they're rising. So since they're rising, I'll stick with that one. Are they rising because economic growth is growing? And so therefore, to borrow money in a fast-growing economy, you can pay a higher rate of interest, and the banks can charge a higher rate of interest, and you'll happily pay it because your opportunities are such that you can make money with a higher rate of interest. That's good. Are interest rates rising because your purchasing power is being devalued because of inflation, and you need more dollars to buy the same thing? Remember, we talked about $100 to $122 in 4 years at the grocery store. That's bad. So as interest rates rise, the question we have to ask ourselves, is it for a good reason or is it for a bad reason? I would suspect that as we continue to creep above 4.25 and stay above there and keep going higher, if the stock market struggles because of rates, it's telling you it's a bad reason. And it's telling you that there's more of an inflation problem. And remember, cannot emphasize this much, that that's 100% hits 100% of everybody. So watch interest rates. They're telling you quite a bit, and ask the question, is it the good reason or the bad reason that they're rising? And maybe the stock market will answer that question as we go forward from here. You could argue that up until this point hasn't been a problem because we're very close to the all-time highs. But if rates keep going up from here and the stock market keeps struggling with it, then maybe it is a signal that it is going up for the bad reason, too much inflation or too much fear of inflation, and the Fed cutting rates is only going to make that situation worse.
Jim Bianco, awesome conversation, as it always is when you join us here on Real Vision. Thank you so much for joining us.
Thank you. Enjoyed it.
Hey, and by the way, before I go, I should say, if you're interested in the kind of conversations that we were just having about technology and about digital assets, crypto gathering taking place in Miami at the end of January. Details and to get your ticket, go to realvision.com/CG25, as in crypto gathering, realvision.com CG25, 2025. Have a great afternoon, everybody.
Hey, thanks for sticking around to the end. Look, if you enjoyed it, hit the subscribe button and check out the video here on the right-hand side. I'm sure you'll enjoy that one as well. And if you're ready for more, go to realvision.com/join. I'll see you there.